known as a self-build loan, is a short-term loan used to finance the building of a home or another real estate project. They can allow a borrower to build a new construction home, often at higher interest rates, with a larger down payment than traditional mortgages. So looking into how it works, so let's run through a scenario. So first you want find a lot to build on. When you find the lot, then you want to make a floor plan and determine what the house would sell for after completion. Then consider how much money and construction costs it'll take to build the home. And builders generally don't buy the lot and start building right away. So they'll find and write an offer on the lot and then set the closing date on the lot far enough so that you and your realtor can have enough time to put the plans and building agreement together. Many builders find they can save money on closing costs by having a construction loan that covers the purchase of the lot and the construction costs. Those are kind of my own words here. Usually taken out by the builder. They're short-term loans. If a construction loan is taken out by a borrower who wants to build a home, the lender might pay funds directly to the contractor rather than to the borrower. That depends on your lender. Special considerations. Most lenders require, as we mentioned before, 20% minimum down payment, and often require as much as 20%. Again, it depends on the lender and maybe the major metro area that you're in. So many builders find that they can save money on closing costs by having a construction loan that covers the purchase of the lot and the construction costs. Direct private lenders or hard money lenders can help you do this. A great hard money lender can help you close within 7 to 10 business days, which can make a huge difference in Texas markets. Down payments, again, vary based on the lender, the lot purchase amount, and the cost needed. So the lender will issue preliminary terms to a prospective borrower to give them an idea of what the financing would look like. The objective is to close your construction loan before you start building your home. This is before you start construction on your new project. So the money needed for construction will go into an escrow account that is controlled by the title company. Once the builder starts construction, a builder will draw from the escrow account. And builders can draw as many times as needed. It's fair to say that 4 times is a decent estimate for the amount of draws that builders generally do, but again, it depends on the builder's needs, how quickly they're moving, the market, and how large the home is, and how much work and money they're putting into it. However, builders can draw as many times as needed. And a draw is a way for funds to be taken from the construction budget to pay for the materials and the subcontractors who are doing the work on the home. So while the home is under construction, you won't be making a full mortgage payment. A construction loan is an interest-only loan that is paid monthly. So let's give an example here. The builder starts construction, they dig the hole in the ground, and they pour the foundation for the home. Now they'll take the first draw. So let's say they draw $40,000 from the construction escrow account, and that would pay the money to dig the hole in the ground and pay the foundation company for the concrete. Those contractors would go to the title company and sign a lien waiver. A lien is a claim that allows the holder to gain access to the property if the debts are not paid. So the lien waiver is a document that's signed in exchange for payment. So it's basically waiving the signer's right to file a lien for the amount on the waiver. The contractor is waiving the right to the lien because the contractor is ensuring with their signature that the work has been done, and the title company will have an inspector come out and inspect the job to make sure that the work has been done. So another example here, you would pay monthly interest-only payments on the amount you drew. So, for example, let's say your monthly interest rate was at 12% for a short-term loan. You'd be paying 12% monthly interest only of that $40,000 that was drawn previously from the construction escrow account. So now let's say that the next draw number 2, is when the home is being framed. So the lumber company would need to be paid as they're supplying all of the lumber the framers will also need to be paid for framing the home. So let's assume that draw number 2 for the second draw for the lumber and framing would be $45,000. So the first 40, second 45. So in total, you would have $85,000 drawn so far. That's including all construction costs to date. So the second monthly interest only payment would be 12% of the total amount amount of money that's been drawn from the construction escrow account. So it would be monthly interest only payments would be 12% of the $85,000 that's been drawn so far on construction costs. So the third draw could be, generally can be, is when the home is insulated, drywalled, when the finishing touches are done, the finishes. And the fourth draw could be when the home is fully complete. So for each draw taken out, the title company will have an inspector come out to inspect the property. Again, they'll have those lien waivers signed by the contractors. And just a little note here, it's not an inspector's job to check quality. It's the builder and the investor's responsibility to ensure that the project is being done the right way. The inspector's simply there to check all the boxes, make sure that everything is all right, that your word is true, that the work has been done, so the lien waivers can be signed. However, once the home is done, you can now transition from your construction loan that you had previously into a fixed mortgage, whether it's a 20-year or 30-year fixed mortgage. So one idea is you could wait until the home is done to lock into an interest rate. This will help you get a lower rate. Rates are pretty decent right now for long-term fixed mortgages. But yeah, that's definitely one avenue that you can take after being done with your initial short-term construction loan. Take care.